Top of the morning to you, wherever you are listening to us from. You are tuned in to Follow the Money with Ugodre, your weekly dive into how money flows, who's making it, how it goes, and what it means for you. I'm here with seasoned analyst Mr. Idika Aja, and the markets have been busy over the past week. We've got numbers from First HoldCo, UBA, and coupled with some rather surprising moves from foreign investors. But as always, the real question is, what do these numbers really say? Welcome, Mr. Idika.
Thank you very much, Shegu, and good morning.
Good morning. So, Mr. Idika, let's start off first with First HoldCo. We saw the group's profit after tax came in at 567 billion naira, down from 610.86 billion last year. That's about a 7% decline. Now, on the surface, I understand why that sounds rather troubling, but when you dig deeper, it's not all bad news. They say that, this loss seems to be linked to, somewhat operating costs. Please help us shed, some light to that.
Yeah, thank you very much, Shegu. That's a very good question. Now, not only First HoldCo, if you look at the banks, some of them, I think almost all of them have released their 9-month results. And he's telling you the same story, decline in profit before tax. In some cases, you have a decline in profit after tax. But if you really look at their core banking operation, they did very well. Now, what is really driving the results on the aspect of the decline? I think it has to do with non-interest income. The banks, you have interest income and you have non-interest income. Of course, the interest income is where you have loan advances from interest income from loan and advances to customer. Of course, you have an interest income from investment in securities. So, but after that, if you get the non-interest income where you normally have fees and commission and you have net trading and FX gains. So I think that's where the problem is. You look at their FX gain compared to last year. This year, let me say, it's somehow moderated. And that's somehow impacted the bottom line.
So it's safe to say some of these losses are somewhat linked to operating costs, FX, revaluation losses, and tighter interest margin, just like you.
No.
Okay.
At the core operation, that is the core banking, which I've mentioned. You look at the interest income, which is the major income from banks. Like I just explained, no, it has nothing to do with that. At that level, the banks are still doing very well, very, very solid. I think what happened is the drop in FX gain, repricing of those assets because of exchange rate. Now we have little stability, unlike in 2023 and 2024 in terms of forex. So with that stability, that volatility that made them to reprice the assets and got a high foreign exchange revaluation gain is no more there because of the stability in the exchange rate. So even some of them even declare the foreign exchange losses. Some even when they gain is very minimal compared to what they did last in 2023 and 2024. So basically, that is the challenge. Then again, even at that core level too, you have impairment charges. That is making provision for loans likely to go bad. CBN, of course, asks them to exit, and most of them have to make that provision.
Okay.
So if you add the drop in non-interest income and little growth in impairments, that really affected their bottom line. But all the same, give and take, it's still solid. It doesn't mean anything.
Okay.
It doesn't mean that the banks are not doing very well. There's a problem. No, it only give you that stability because remove the what they call the hot money. If you remove that, which is the income you're getting from FX, the core operations, at least let us know whether you are doing very well or not.
Absolutely, because I was going to ask if this has somewhat become a trend or the new normal, because we see many banks report higher revenues, but their losses, or should I say their profits, keep shrinking. Has it become some sort of a trend somewhat now?
No. Like I told you, if you look at the gross earnings, then look at the percentage contribution from interest income. That is that is the most important thing, and what are driving that interest income. In the case of First Bank, for instance, I think they have about 2.229 trillion from interest income, and if you look very well, you can see that from that interest income, you have income from loan and advances, which is about 1.5 trillion. So you can see now they are equally making good money from income, the income from loan advances to customers. Now, if you go down again, I think where you even have the shift, where you are having shift is between interest income on loan and advances and interest income from investment in securities like treasury bills, government bond. In some banks, you can see that shift. Now, interest income from investment in securities is really giving them more income than the traditional loans and advances. So that is where you're even having the shift. But I think I like it because let's forget about that hot money, paper money that you make because of exchange. But let us focus on your core operation. What is actually happening at that core level? Your interest income, the spread between your interest income and interest expense, then you have the net interest income. Then look at the impairments. After that, you look at the net interest income after impairment. For me, that is very, very important. What is your net interest income after impairment? And as far as I'm concerned, if you look at the banks at that level, wonderful, fantastic.
Absolutely. And what I have found rather interesting about holding companies in general, especially like First HoldCo, is the fact that some of them use their non-banking arms to somewhat offset that pressure. Their insurance, asset management subsidiaries. Would you say they are slowly equally becoming profit centers?
Yes. Okay. Yes, they are. Even like if you look at GTCO, for instance, from that angle, they equally did very well using their non-banking subsidiaries. They did very well.
Okay.
They did very well.
Absolutely. And for our listeners listening or watching, if you wonder how this matters to you, just know that diversifying your deposits, just to stay safe and, means your banks equally stays stable. And so, Mr. Idika, we would now be segueing into news on UBA holding its ground. As one of the many few banks showing a bit of green, we see profits up by 2.3% to 537 billion naira, while gross earnings rose 3% to 2.5 trillion naira. Well, not mind-blowing if you ask me, but rather consistent. What do you think about that?
Yeah, okay. If you look at the First Bank we just mentioned and look at UBA now, you can see though First Bank the profit decline, but so just to looking at UBA now, there is a growth.
Yeah, but
in absolute terms, you can see that First Bank posted a better result in terms of pre-tax profit compared to UBA, though this one declined. This one now increased, but it's not only the growth, though it is very, very important for you to look at the growth. But I think in absolute terms, it's very, very important too, because that will equally translate to your earning per share, which is very, very important, which we use to value the company and which will equally determine how much will go to you as dividends, as an investor, as a shareholder. So even if you look at UBA too, you can see the composition now. You can see the same thing with First Bank.
Yes.
The money is coming from their core operations, interest income and non-interest. Let's look at their interest income. Interest income, if you look at even their gross earnings, is contributing close to over 64% of the total gross earning in terms of for UBA. But when you now look at the interest income too, you can see that where is the money coming from? The money coming from the income you are making from the loans you are giving to customers and your investment, at least you invest in treasury bills, you invest in bonds. Now, there's one shift here for UBA. You can see now, UBA, the money they made from investment in securities is higher than the money they made from giving out loans to customers. So this one is safer, maybe because of the volatile environment, either they want to play safe. If you check the banks now, you can check their balance sheet. You can see the increase in their holdings in these holdings and investments and securities, investing in those securities, bond, treasury bills. You can see the growth there. You can equally see the growth in loans and advances to customers.
Okay.
So I think the banks, at least you would like to invest where it will be much easier and the risk will not be much. I think that's what they are considering.
Absolutely. And I even think, as my personal opinion, I think up to an extent, UBA's diversification is even saving them, especially with FX income from other markets. They have Ghana, Kenya, and even Cote d'Ivoire contributing meaningfully. Do you agree with that position?
Sure. At least I run away from country risk.
Okay.
Country specific risk. So when you diversify, at least you run away from that.
So absolutely. And what would you say is an UBA's continental playbook, or what are they doing better than others in a case like this?
Well, you wouldn't say they are doing. But I look at the bottom line. What actually are they doing? How much?
Yeah. What are they doing?
Are they earning? Like now the result you've got now. I don't really like doing that comparison, you understand? But from the results you've just read, UBA did very well for the 9 months. And I think they declared interim dividends after the release of their first they have a lot of branches, at least over 20 branches outside the country. So the expansion is there, the diversification is there. Each bank has its unique advantages and equally disadvantages. So each has its own strength where, this is my competitive area. So it really depends.
I absolutely agree when you say it speaks to resilience, because for them to be able to hold their own against inflation, with interest rates being high. And you did mention that fees and digital channels, remittances might be cushioning them up to an extent.
That you just mentioned is part of the non-interest income. When I started, I said you divide the bank's income stream into two. The interest income and non-interest income. That interest income, you get fees and commission. That is where the one you have just mentioned, e-business channel, credit fees, advisory, all those ones, that is where you see them. Now, you go to the upper one, which is the interest income. You have interest coming from loan advances. You have another one coming from investment in securities. So the one we've just mentioned, all those were subsidiaries, non-banking subsidiaries, all of them are grouped under non-interest income.
Okay. And finally, on this topic, with banks making profits in hundreds of billions, banks like UBA, do you think the average customer is somewhat benefiting? Are loan rates going down? Are services improving? What do you think this translates to for the average customer?
Okay, whether they are growth.
Yes.
They are for average customer. It depends on the angle you are. It depends on the angle you are looking at it.
Okay.
One, the deposit. You are a depositor. What is being given to you? That is one side. Then you want to borrow. What is being given to you? Now, all these things are affected by regulatory policies. You have the MPR at 27. That will determine the rate at which bank can give you money. And I think the other one, the time CBN now said, okay, for savings, minimum of 4%. So you have interest rate bands. Now the bank can say, okay, you have a deposit, this is how much. And that's translated from savings to FDs. It depends on the bank. So most of you go to the bank or they usually display their interest rate band. for you to know. So on that angle, it depends on as a customer, you have deposits with them, you can borrow, you can drop your money. So you benefit by having them apply the relevant rates, whether you want to borrow or whether you want to putting the money with them.
Absolutely. Thanks so much for that insight, Mr. Idika. Now we'll be going on a quick commercial break, and when we get back, we'll be speaking on the foreign investors coming in and the 1 trillion naira inflow. Welcome back. This is Follow the Money with Ugodre and Mr. Idika. So we'll be ending the show with some great news from the Nigerian exchange, saying that, the foreign investors are back and they're pouring in over 1 trillion naira into the Nigerian stocks in just 9 months. I mean, that's more than twice of 2024's total and 6 times what we saw in 2023. And, first off, what's your take on all of this,
Well, thank you, Shego. First of all, it shows confidence.
Yes.
Shows confidence and foreign appetite for Nigerian stocks, which is very, very important, which is good. So secondly, there are things that are driving that let me put it, newfound sentiment and that appetite. Of course, the liberalization of the foreign exchange, where you can easily, apart from that, then the policy, the CBN policy, you can be able to repatriate your funds equally contributing, and those backlog, CBN has been able to offset, and now people are now having confidence that, okay, fine, if I come in, I will be able to exit. That is on one hand. Then you want to look at the return on your investments. Now, the whole thing is this: if I go to market A, and market A is giving me 10%, and I go to market B is giving me 15%, definitely I will go to market B. And equally, the exchange rate is equally helping, because if you go to US and now invest, normal, I think treasury returns should be about 2 or 3%. So if you can calculate it, if you use 5 million naira, convert it to dollars, and buy US treasury bill or any other stock, then and earn that 3%, convert it back to naira, you can now see what you will be earning. Unlike when you now use that 5 million naira and invest in Nigerian stocks, what will it give you? So you now check the return and see. So I think the yield coming from Nigeria is now much better. So that could equally be another reason why you are having that influx.
Absolutely, Mr. Idika. And I dare say it's a breath of fresh air. I mean, it's the first time in years that foreign inflows have surpassed outflows. And, you did mention that, it speaks to confidence. And I dare say, especially with the FX reforms, better transparency. But would you say it's a bit of fear of missing out, from the global community as well?
Well, I don't know if I'm right. It's not. It really depends on like what I see, and the way I see it is the end point is one, risk. The second point is return. So if I'm investing in market A and the risk is okay, I can take the risk, is minimal, and I can get a better return, then why should I be reluctant to go there, or what the other markets are doing? So it really depends on what you really want.
I mean, but here, what's really funny is the fact that while foreign investors are returning, domestic investors still dominate. With 6.7 trillion in activity, that, domestic investors still make up about 78% of total transactions. What do you think about that?
Yeah, it's okay. It's okay for, at least for domestic participation to be much higher
Okay.
than foreign inflow. But again, for that stability, we equally need that foreign inflow.
Absolutely.
We equally need that foreign inflow. But what is just telling you, people are getting aware more. There's more awareness and institutional investors. And beside, the equity market is giving better return compared to other asset classes. One, because of some macroeconomic variables, interest rates is coming down. And when interest rate is coming down, at least the yield from the fixed income space will equally drop. Now, even if you look at mutual funds, if you look at mutual fund, their performances, money market mutual funds, equity balance fund, you can equally see that from that angle, the equity mutual fund and the balanced mutual fund that invest both in equity and bonds are equally doing well, giving you better yields than money market and fixed income. So still buttressing the fact that okay, the stock market is really doing well, and people are putting in there because, like I said, the end point is what do I make? How much do I get from investment? Because investment is an investment only when it can give you a return above what you had. Otherwise, it's not an investment, and that investment must beat that inflation. That is the key thing. That is the notion. That is the concept. So whatever you are putting your money, if it cannot outpace that inflation, technically you are losing money. And among these traditional assets, where it's only stock that you can comfortably say, okay, this thing can give me a return above the inflation rate we have now at 18.08%.
Absolutely. And I also think that just goes to show that local money is the real backbone of this market, that, these investors, they may come and go, but Nigerians are the ones pretty much keeping liquidity alive. So do you think this return is sustainable? Or are they just testing waters? I mean, foreign investors. I mean, we can't blame them if they are testing waters. I mean, they've seen a lot of policy U-turns in the past, and maybe they are being cautious. What do you think the sustainability of this return is up to an extent?
Like I know for recent, yeah, you are right. For some time, the foreign outflow has always been higher. We always have a net foreign outflow.
Yeah.
The outflow has always been higher, and it's part of it. It's part of the market. If I bring in, if the situation is not good for me, I can exit. So there is nothing wrong with that. So we have to understand that, and we don't start crying and saying, okay. But the most important is that let your environment be okay. If your environment is okay, and indices are okay, and I know if I bring my money, I can even make my profit and get that easily, then, and it keeps giving me what I want, then why should I pull out? Why should I pull out? So the issue of whether it can be sustained or not, whether that sustainability depends on the macro environment, the policies government are bringing in, and the entire market will now decide whether that you can be able to sustain it or not.
So a huge part of it is on macro stability. If FX reforms hold and inflation slows, these people are sure to stay. And I guess that's even
my ability to come in and exit.
Okay.
It's very, very important.
Okay.
And that is exactly what they have done. There was dollar payment backlog, and which CBN has cleared, and the stability in the FX and all these things are giving investors, especially foreign investors, that confidence. I know I have a lot of. I see some of investors calling me. Okay, I'm not in Nigeria. I'm interested in stock market. Can you guide me? Where do I put money? So that is part of that. Even at that retail end, that foreign participatory retail end, people are calling even outside Nigeria and ready to bring in money to invest. So, like I said, is the environment. If the environment is conducive and you keep on getting good return, and everything is transparent, definitely you'll be able to sustain it.
And that's the Nigerian market in a nutshell. Exciting, profitable, but unpredictable. And finally, Mr. Idika, shall we segue into the highest gainers and losers over the past week? And I will be beginning. At first place, we saw Julius Berger seeing a 10.00% increase to close at 151.80 naira. Up next in first place, we have Learn Africa, seeing an increase of 10% to close at 6.49 naira. Next, we have Cornerstone Insurance, seeing an increase of 9.82% to close at 1.30 naira. Up next is ASO Savings and Loans, seeing an increase of 9.57% to close at 1.03 naira. And finally, we have Ikeja Hotel, seeing an increase of 8.37% to close at 18.30 naira. Now over to Mr. Idika to read out the top 5 losers.
Shegu, looking at top 5 losers, the first one on the list is Deep Cap, that lost 10% to close at 1 naira 71 kobo. Then Etana, which is from the oil and gas sector, equally lost 10% to close at 36 naira. Then Magnicos, the company equally lost 10% of its value to close at 2 naira 97 kobo. Then Sunu Assurance did very well in 2024. It was one of the best stocks in 2024. For this week, it lost 9.98% to close at 454 kobo. Then Legend came on board, I think early this year when they listed. I think if I'm not mistaken, and they lost 9.93% to close at 5 naira 26 kobo.
Thank you so much for that breakdown, Mr. Idika. And wherever you are listening to us from, the big lesson here in this is that while the Nigerian market is unpredictable or can be unpredictable, it is equally alive. It is complex and sometimes messy, but still it is full of opportunity for those who pay attention. And whatever it is you're doing, whether you are investing, saving, or running a business, follow the money with Ugodre, follow the money with Nairametrics, follow us across all platforms, subscribe, and stay tuned for your regular financial updates. Till next time.